Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to today's Top Stock Pick. I am Jeremy Mullen alongside Ben Rains, who will have his pick shortly. But first, we will be doing Zoom Communications, ticker symbol ZM. Now, this is the popular cloud-based video conferencing company that many of us used during the pandemic. We might not have great memories of that, but it sure helped the stock out, which went from $70 to $588 in 2020. That was quite the move. The pandemic ended, and so did the bull run for this stock. The stock made its way back to the $60 area and traded sideways for the last couple of years. But the price action of late is pretty good, and alongside with recent earnings report, everything is lining up here for the bulls. They are trying to push the stock back into the triple digits. So today, I wanted to look at why that is and how we might get to $100 a share and beyond. First, let's look at the profile page here. I have the Zoom Communications. You can see the Zacks ranked number one, strong buy. We have a C in growth and D in value and momentum. So not the best style scores there. We do have an industry rank in the top 29%, which is pretty decent. Let's scroll down and look at the numbers. A $25 billion market cap, no dividend. The beta here is actually pretty low. So it's not a very volatile stock like it used to be. If you remember, if you traded this stock back in 2020, this is one of the most volatile stocks out there. The thing was moving on any kind of vaccine-related news and whatnot. So the PE's up 14. While there is a low value score, this is not a high PE for a tech stock. So more about this company. The flagship product is that Zoom Meetings platform. This lets people connect through video, audio, chat, and screen sharing options on desktop, mobile devices, and conference room systems. At its 2025 Zoomtopia event a couple weeks ago, the company highlighted its AI Companion 3.0. This upgraded AI systems and goes beyond being a simple assistant, acting as an intelligent, proactive layer across the entire Zoom platform. So we have an AI angle here, and you've been following the market as of late. Anything AI related goes up. There's a hunger and a thirst for AI. So we do have an AI angle with this stock. Now let's look at the earnings first, or here next, because this is what matters. Whether you dabble in AI or not, earnings are going to matter. And these are earnings all the way since that slide after COVID. I mean, they've always been beating, even on big magnitudes, but kind of their outlooks when they beat have been conservative or weak. But finally, even with just an 11% beat, the outlooks look stronger. So the stock has been ticking higher. Digging into this last quarter, EPS came at 153. That beat the 137 expected. Revenue was 1.22 billion, which topped the 1.2 billion estimate. The company did raise that full year outlook for EPS, revenue, and free cash flow. Free cash flow jumped from 508 million to from 449 million last year. So pretty nice jump there. I think one of the most important things here, though, is these large enterprise customers. That's customers spending over $100,000, rose nearly 9% year over year. So now they have over 4,000 of these customers, and that really helps that top line. CEO highlighted AI Companion as a key growth driver with accelerating adoption. Okay, let's look at the estimates now. Those are the analyst numbers for the upcoming quarter and next year. I like to look at the agreement here. So this is the analyst raising and lowering estimates. We can see up over the last 60 days, everybody's gone up. Nobody's going down. That is positive. That is due to the guidance the company issued on this last quarter. With that, we see estimates ticking higher across all time frames. Looking at the current next year, we see about 4% moves higher over the last 60 days. Are seeing some analysts lift their price targets too. Stifel took theirs to 90 from 80, keeping their neutral rating. Benchmark reiterated their buy rating and has a target of 110, up from 102. So let's look at the chart here and see how we might get there. Close that. This is the current setup I have. I actually want to look at the longer term chart first and show you just how that move happened during COVID. Pretty amazing, right? This is over a course of 3 quarters where it went from about $70 to $588 and then started to come down. Obviously, when the pandemic's over, the stock came all the way back and traded sideways. So let's zoom back in and look at that current setup. This is a pretty simple fib, break, and extension target. So from the highs here back in January down to the lows, we get this 61.8%, which retracement, which should be resistance here. Okay, we got above it, fell back below it after this quarter, which didn't impress the market. But now look at this. This quarter did, and we revisited these highs, and we are trending upwards. The 21-day moving average is somewhat holding here, and I'm targeting 104. So there's a lot of meat on the bone here. If you guys are looking for a dip, the market does sell off. I would watch this 50-day and 200-day moving average just under 80. If those hold, you want to buy that and back above the 21-day moving average, we could get going. But if the stock might not get there, so watch this. If we break above 90, I think we get a short squeeze and just go. And we can get there into the end of the year. Also, if this 58-day moving average gets above the 200-day, that's called a golden cross. And what happens then is a lot of people get alerts that Zoom Communications is having a golden cross, and that brings in new buyers. So that could be another catalyst for the stock to get going. But bottom line, this stock is looking a lot better than it has over the last couple of years. Enough of the sideways chop. Let's get a bullish trend and keep going. Company has rebuilt momentum with stronger fundamentals and rising estimates and that fresh AI-driven innovation. So the company is no longer just a pandemic-era video call solution. And that is evolving into a full-scale communications platform, and that's great for the bulls. That's it for me in Zoom. Here is Ben with his pick.
Thanks, Jeremy. As you said, I'm Ben Rains, and this is my top stock pick of the week at Zacks. Today I'm looking at EMCOR Group, which trades in the ticker EME. So the stock itself is EMCOR, that's EMCOR. It profits directly from the AI hyperscale data center spending boom and the massive energy infrastructure growth that's required to support that. The stock has soared about 800% in the past 5 years as part of an S&P 500 and sector crushing 4,000% surge over the last 20 years. Yet its valuation remains in line with the benchmark. It's a critical electrical construction and energy infrastructure company with its upward earnings revisions landing at a Zacks ranked number 1 strong buy. It's also attempting to hold a critical technical level that could help it surge again in the fourth quarter after trading sideways since late July. We'll get into a little bit of that more in a second, but I want to do just a little bit broader overview. So the company is a standout provider of mechanical and electrical construction services, industrial and energy infrastructure, and building services. The company boasts that it handles everything from constructing a hyperscale data center to providing 24/7 support for cutting-edge hospital to implementing the latest energy efficiency technology. So it benefits directly all from the AI data center spending boom, electrification, and the broader energy transition. Just for reference, AI hyperscalers are projected to spend roughly $400 billion in CapEx in 2025 alone, with global data center infrastructure spending set to hit $7 trillion with a T by just 2030. And then in the backdrop of all this, large AI data centers consume as much electricity as a mid-sized city, which is a huge reason why U.S. electricity demand is set to grow by 75% by 2050. U.S. utilities will have to double transmission capacity. The country is also aiming to quadruple nuclear energy capacity over the next 25 years while expanding natural gas, solar, renewables. And all of this is also happening while reshoring is happening. So EMCOR is benefiting directly from all of that. So now we're going to head over to Zacks.com and ZRS to check out some more data and some other really good reasons why to consider EMCOR. All right, so now we're on the Zacks.com ticker page for EME stock here. So we can see, as I mentioned, it's the Zacks ranked number 1 strong buy. It's currently in the top 1%. So number 2 ranked industry out of 245 industries here at Zacks. So it shows how important it is to be a part of a strong industry. A big part of your stock performance is being a part of a strong industry. And it shows that this building products heavy construction space is benefiting from all those reasons we mentioned kind of up top, the AI data center spending boom, energy transition, reshoring, all of that. So it's good to know that EMCOR is part of a good group here. And then we can see these are revenue and earnings estimates. We're calling for about 17% adjusted earnings growth this year on top of 8% growth next year. And then we're calling for 5% growth next year on the top line for 2026 after 15% growth in 2025. And it's worth noting, I'm going to go over here. This comes on top of really impressive growth over the last few years. So the company is set to more than double their revenue. I think I have the exact. So if we look back to 2020, it did about $8.8 billion in total revenue. And if we look, we're calling for about 17.6. That'd be essentially doubling its revenue. Obviously, a little bit of a slowdown compared to some of the big growth it's done, 15, 14, 12. But that's a little more difficult as the numbers get a little bigger and bigger. So overall, it still shows the company's revenue growth is stellar. And then on top of that, we can actually show this chart. So it shows once that post-COVID dip happened, its GAAP earnings have gone straight up, which is a great sign. So it went from, it did $2.39 back in 2020 to $21.52 in 2024. And then if we look, we're calling for it to get all the way up to $27 per share in 2026. So really, really stellar growth there. And then we'll go ahead and take a look at some performance charts. As I mentioned up top, the stock has been on a really impressive run. So we'll go to 20 years just to give a sense of where it is, up 4,200%, blowing away that highly ranked industry. And then we can see what it did against the S&P 500 as well. Crushed the S&P 500. So that just puts the stock into perspective for everybody here, just getting a sense of both of those outperformances. This is the last 10 years, up around nearly 1,400%. We'll go to the last 5 years, up 850% to blow away its highly ranked industry and the S&P 500, almost doubling that industry. And we'll go to now a technical chart, because I mentioned it's trying to hold its ground at some potentially key levels. So it's trying to hold its ground right here. This is the green line, 50-day moving average, and then had a huge gap up in late July. So it's trying to hold these levels right here. And we can see this is where it's trading right now. So if the bulls still hold their ground in general in the market, it could be ready to kind of break out to brand new trading range in the fourth quarter. Obviously, playing this stock for any near-term gains is a little difficult, especially when the market's gone on such a big run. So some investors might want to maybe wait for a pullback to, say, the 200-day moving average or a level like that. But if you're a larger investor, playing the market timing game is a little difficult. You can see it's maybe a little overheated on a 10-year time frame at some overbought RSI levels. If we look down here where my cursor is at the moment, as I said, it could face a pullback, but it kind of all depends on where the broader market goes in the near term. It's holding that 50-day now. But if you want to wait possibly to have a broader pullback, that 200-day moving average can be kind of a screaming buy. And then it's worth taking a look at its valuation, because we saw that it crushed the market and it crushed its industry. And despite all that, its valuation is really not that stretched. It's trading not at too much of a premium to its highly ranked industry at 24.2 times forward 12-month earnings. And if we look at a 10-year time frame, it's really not that stretched. And we'll do it compared to the S&P 500 as well. And we can see that it's trading almost directly in line with the S&P 500, despite the fact that the stock has gone an incredible run over the last 5, 10, and 20 years. Overall, as we've seen, EME posted consistent revenue and earnings growth over the last 15 years, outside of a tiny COVID-based pullback. Most importantly, though, its earnings are growing, especially, and they went into hyperdrive over the last 4 years as it benefited from those converging megatrends we've talked about across technology, energy, utilities, infrastructure, reshoring, and more. So it's certainly time to put EME stock that benefits directly from the AI data center spending boom on your watch list. So that does it for me in this episode of Top Stock Picks at Zacks. Make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more.